Hey everybody, I've been asked a lot to give an update on Redfin, and it's not hard to see why. The stock is up 50% in the past week and a half as I'm recording this. So it's it's definitely got some momentum right now. Um, Before we get into it, please take a minute and hit the subscribe button if you don't subscribe to my channel already to keep up with all my coverage on Redfin and all the other stocks. Check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I want to get right into it with Redfin and why it's up 50%. And the short and easy answer is interest rates. Um, Recently, interest rate expectations have shifted considerably based on some economic data, based on employment data, based on the Federal Reserve's comments. It now is looking like a given that the Fed is finally going to start cutting interest rates in September. This would be the first interest rate cuts since 2020 when the COVID pandemic necessitated a emergency rate cut. And they're expected to continue cutting rates fairly aggressively for at least the next year and a half or so. This could be good for Redfin for a few different reasons. But before we dive into that, let me go ahead and share my screen. I want to say one other thing that I like about Redfin in its second quarter, because I never really did an earnings recap for this one. Okay. So basically, I would describe Redfin as doing a great job in a terrible environment. The real estate environment remains agonizingly slow. Existing home inventories are near a generational low. High mortgage rates have prevented people who want to sell their house from putting their house on the market. Over half of mortgages in the United States have rates under 4% right now. People just don't want to give those up. Buyers are staying on the sideline, not just because home prices are high, but because mortgage rates are so high and are really pushing up their monthly housing costs, making that unaffordable. And Redfin is their core business is real estate services. They're Redfin, their agents are the business. They have a few other things they do, but that's what makes their money. So given that, revenue was up 7% year over year in the second quarter. That's kind of impressive. Their market share grew by 2 basis points, so setting up nicely for future success. I love the traction that they're getting with their new agent compensation program. They're bringing over a lot of high performing agents from other brokers as a result. Number 3 right there, you see that their average monthly visitors are flat year over year. Given the state of the market, that's impressive. The rental business is doing well. Honestly, this is a market that favors renters instead of homeowners. A lot of people are sitting on the sidelines waiting for a good time to buy. So the rental business is doing well. And that part of the business is profitable. The mortgage attach rate, remember, Redfin bought a mortgage lender a couple years ago. That's really starting to get well integrated into the business. And it's something that could be a big catalyst as rates fall. So I'll start with that mortgage business. I'll work backwards here. So the mortgage business right now, the attach rate of 28% means that 28% of people who buy a home through a Redfin agent are using Redfin for their mortgage. That's all well and good, but right now volume is very low. Mortgage volume should pick up tremendously as rates fall, as buyers flood back into the market. So if they can even keep that 28%, the mortgage business could have some nice tailwinds. There's also the refinancing tailwind to know, because Redfin isn't just a mortgage lender for its agents. It's got a home mortgage business. They bought Bay Equity Home Loans. They can get a lot of refinancing volume as well. That could be a big tailwind over the next few years. If you remember the 2021 or 2020 to 2021 period, when rates were in the 3% range, everybody was refinancing their loans. I know people who refinanced 2 or 3 times during that period because rates kept dropping. It could be a big tailwind. You get nice origination fee income. It's very high margin revenue. So that's a big potential catalyst as well. The business has really been laser focused on efficiency, and I'll turn off the slideshow after this. If you look at the revenue figure, revenue is nowhere near where it was in the 2021 era. you see the green bars right here are the real estate services business. So ignore the top bars. Um, those are not the core business. The core business is this real estate services revenue. Um, that went from $903 million in 2021, steadily down to $619 million in 2023, and it's on pace to roughly match that this year. But if you look over at the profitability metrics, gross margin right here is up 70 basis points year over year. This is the big one right here, trailing 12-month adjusted EBITDA. That excludes things like stock-based compensation and things like that are reflected in the net loss, but it shows kind of the profitability trend of the business. In the first quarter of 2023, the trailing 12-month adjusted EBITDA was negative 145 million. That has steadily improved to a negative $33 million, which is a much more narrow loss. Not profitable yet, but given the terrible state of the real estate market, that's all right. And just breaking it down by segment, overall, they were break even in the second quarter, which was a terrible market. So that's really good to see. You see the services business is still not profitable. Rentals and mortgages both were. The mortgage business is not a big revenue generator. Just backing it up to this slide, you can see the mortgage revenue, which is the top bar, about 40 million out of 295 million. But out of that 40 million, they made a little over $1 million in profit. So as that business gets bigger, the profit should get even better. So there are a few other tailwinds I wanted to mention for Redfin are why I think even after a 50% gain, this stock could be a pretty nice long-term winner. Number one, it's still a pretty cheap company. It's a $1.3 billion market cap stock. It's trading for roughly one-time sales when you add in all the components of its business, maybe a little bit more than one-time sales. And it's a pretty high gross margin business, 37% gross margin and growing. So still not a very expensive company by a few different metrics. The interest rate tailwinds, we already talked about the mortgage side of the business, but on the agency side of the business, lower mortgage rates helps on both the sellers and buyers side. So Redfin primarily positions itself as a seller's agent, meaning the best way to sell your home cheaply. 1.5% selling commission as opposed to the 3% industry average. So Redfin needs volume on the market. They want to be efficient. They want to be their agents to be able to handle higher volumes than competitors and pass the savings generated by that efficiency onto customers. Existing home sales are at generational lows. They're roughly about half of what they were a decade ago, or existing home inventories rather. As rates fall, a lot more existing homes, people who have low mortgage rates right now and would love to move but really can't justify it financially, you'll see a lot of these homes start to trickle back onto the market and existing home inventories to rise. On the buyer side, people are paying a lot more than you think just because of high mortgage rates. Higher mortgage rates have much more of an impact right now than higher home prices. Just to name an example, if right now the 30-year mortgage rate in the US is about 6.5% on average. If that were to fall back to 5%, that would have a greater impact on home affordability than if house prices dropped by 10%. So mortgage rates are a big driver of home affordability. You're going to see a lot of people who are sitting on the sidelines renting, wanting to buy homes, come onto the market if rates fall. Both of those are great catalysts for Redfin agents. The company's focused on repeat business, building relationships, getting people to both sell their home and buy their next one through a Redfin agent. All of this positioning could set the company up for great times as rates come down. There's a lot of pent-up housing demand, a lot of pent-up demand for sales. I'm really looking forward to seeing that kind of come back on the market and for the market to normalize. There's also the recently enacted settlement from the National Association of Realtors that makes a dramatic change to how agents are compensated. It doesn't say anything about how much you could pay, real estate agents get paid, but it says how they get paid. Traditionally, the seller of a home has paid both the seller's agent and buyer's agent commission. And until very recently, it was actually a condition of being able to list in the CMS that the seller needs to offer both sides of the commission right there in writing. Now, that's no longer the case. Buyer's agent commissions are now a negotiation between the buyer and their agent. sellers can still choose to pay it if they want to motivate, agents to show their home to their customers. But now it and just the real effect is it's made a lot of customers much more fee conscious about what they pay for real estate. A lot of buyers didn't know how buyers agents get compensated because they've never had to worry about paying it. Now it's all going to be in writing, right up front. If you're paying your buyer's agent's commission, you have to know about it up front. You have to agree to it up front. Redfin has been the only major real estate company trying to disrupt this traditional pricing model for decades. So they are really set up to take advantage of a fee conscious consumer environment in real estate. So while it's real, there's a lot of moving parts to the settlement and what it's going to mean to the industry, to home buyers, to sellers. It could really be a net positive for Redfin as a truly discount oriented real estate company. So I'm really curious to see where Redfin goes from here. I want I'm not paying too much attention to the numbers right now because the housing market's still very, very slow. I want to see their profitability numbers trend in the right direction for sure when we see the third quarter and fourth quarter results. But I'm looking forward to 2025 and beyond when we actually see the Federal Reserve rate cuts really have an impact on the real estate market and see what the company could do in a more normalized situation. So thanks for joining me. I would love to hear what you think about Redfin, any questions you might have. I'll do my best to answer any of your comments or questions individually. Thanks for watching and see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.